The words, bear market, strike fear into the hearts of many investors. But these deep market downturns are unavoidable, and often relatively short, especially compared with the duration of bull markets, when the market is rising in value. Bear markets can even provide good investment opportunities. Welcome to Crypto News. Today we are going to talk about how to take advantage of bear markets. Stay with us until the end of the video to learn more. Like and subscribe to this channel and hit the bell button to get notified of all the latest updates. What exactly is a bear market? A bear market is characterized by a sustained decline in investment values. Typically, a bear market occurs when a broad market index declines 20% or more from its most recent peak. Individual equities and markets, such as the Dow Jones Industrial Average, can experience bear markets. Although 20% is the threshold, bear markets typically fall considerably more than that over time, but not all at once. Although there are periodic relief rallies on the market, the main trend is negative. Eventually, investors find stock prices to be appealing and begin purchasing, thus ending the bear market. Bear markets are defined by the pessimism and lack of confidence of investors. During a bear market, investors can appear to disregard any positive news and continue to sell aggressively, driving prices lower. Despite the fact that investors may be pessimistic on a certain stock, this attitude may not impact the market as a whole. However, when the market goes negative, nearly all equities inside it begin to decrease, even if they are reporting positive news and expanding earnings individually. Bear markets may be easier to endure if you are adequately diversified and invested for the long run. Warren Buffett is a perfect example of how to invest like a millionaire or billionaire, in his case, across all market seasons, recessionary periods, and periods of higher volatility. In the past 50 years, Buffett has compounded capital at a rate greater than 20% each year. Here are 7 steps to do whenever you want to take advantage of bear market. Step 1. Know that you have the means to endure a catastrophe. Mark Reep, managing director of the Schwab Center for Financial Research, explains, some individuals worry in a bear market because they don't know whether they have enough cash to meet short-term goals. Ideally, you won't have to answer this question at a time of crisis, since you should already be aware of the response. Mark suggests that if you're retired, having 12 months' worth of living costs in a bank account or money market fund plus a couple more years' worth in bonds that mature when you need the money can help you remain calm and level-headed. You will behave far differently than someone who has never built the basis and is suddenly confronted. It's not simply about your risk tolerance, which is your emotional capacity to withstand large price fluctuations and losses, he says. It's about your ability to withstand financial danger. Alternatively, can you afford to incur a loss? You may feel risk tolerant, but if you have not structured your assets to withstand a steep decline, you may be forced to make difficult lifestyle modifications when the crisis strikes. Step 2. Align your finances with your ambitions. Create a strategy that takes into account the purpose of your savings, whether it be immediate costs or long-term financial goals such as college tuition or retirement. Structure your portfolio to reflect your objectives. Money that you will need quickly or that you cannot afford to lose, such as a down payment on a home, should be put in reasonably stable assets, such as money market funds, certificates of deposit, CDs, or treasury bills. Investment-grade bonds and CDs should be used to fund goals with a funding horizon of 3 to 5 years. For funds that you won't need for at least 5 years, choose volatile assets with growth potential, such as equities. Step 3. Remember that recessions are temporary. The Schwab Center for Financial Research analyzed bull and bear markets for the S&P 500 index dating back to the late 1960s and determined that the typical bull market lasted around 6 years and had an average cumulative return of almost 200%. The average bear market lasted around 15 months and resulted in a cumulative loss of 38.4%. The longest bear market lasted little more than 2 years, followed by a nearly 5-year bull market. The pandemic-fueled bear market in early 2020 was the shortest, lasting only 33 days. Step 4. Maintain portfolio diversification. Diversification can provide protection against losses. In any bear market, certain market segments are likely to be affected more worse than others. Diversification inside the equities market as well as across asset classes is a preventative action you may take today because it's incredibly difficult to predict them in advance. Diversification entails holding a wide range of investment-grade bonds, including corporate, municipal, treasury, and even overseas offerings. And their maturity should range from short-term to intermediate, so that you always have some bonds maturing and giving you with either income or funds to reinvest. Mark suggests diversifying your long-term investments over a wide range of local equities, large and small, fast-growing and dividend-paying, as well as international companies, real estate investment trusts, REITs, and commodities. This allocation provides exposure to asset types that tend to move at various periods and rates. Step 5. Do not miss market recoveries. Mark states, it's easy to argue that risk doesn't concern you when the markets are approaching record highs. A better indicator is how you performed through the most recent recession. Numerous investors sold at the market's bottom in March 2009, transforming transient paper losses into permanent, wealth-destroying losses. According to the Investment Company Institute, mutual fund outflows were roughly $21.6 billion that month. Investors who failed to re-enter the market in a timely manner would have missed the start of one of the most powerful bull markets in history. The Schwab Center for Financial Research evaluated the returns of 4 hypothetical portfolios to provide a sense of what is at stake if you withdraw from the market, even briefly, during an average bear market. A portfolio that stayed fully invested in equities as the market reached its bear market trough and subsequently rebounded. Although we encourage diversifying your portfolio with a variety of assets according to your objectives and risk tolerance, we will focus on equities to highlight the impact of market timing. Step 6. Include currency in your kit. Cash is one of the lowest returning asset types, but that should not blind you to its diversification potential over the long run. The extremely low correlation between cash and other asset types enables it to provide protection against volatility. Additionally, cash reserves might be useful in weak markets. With cash, it is possible to invest when prices are attractively cheap, without having to sell assets at a loss if they are also trading at a low point. Therefore, cash might provide your portfolio some stability, low correlation, low volatility, and adaptability, to buy new investments without selling old ones cheap. Step 7. Find a reliable financial professional. Lastly, your bear market equipment might profit from a so-called built-in buddy system. If you're unsure of how to properly organize your portfolio, or if you believe you'd be tempted to act rashly during a market decline, you should seek the assistance of a trusted financial specialist. This individual can guide you through a comprehensive portfolio assessment and assist you and your portfolio prepare for market downturns. If you made it to the end of this video and are interested in knowing more, let us know which part of the video you liked the most in the comments section below. We will appreciate your comment and work to make a video on your desired topic with an account shout out. Please like and subscribe to the channel and hit the bell button to be notified of our next video. Thanks for watching.